Good day everyone, how are you feeling today? I hope you're doing good. So if you look at the bank stocks, you might see that every bank stock currently is surging. JP Morgan 3.7%, Goldman Sachs 2.5%, Bank of America the same thing, Citigroup 1.78%. This is insane, okay? And you might ask yourself, what's going on? So today JP Morgan and Wells Fargo reported their first quarter earnings for this year. So let's talk about JP Morgan's earnings and let's look at important metrics that they are putting in their financial report. So if we take a look at the report, you might see some things that might cause you some stress, like ROE, ROTCE, and you might say to yourself, what the hell are they talking about and what are those shortcuts? So today we're going to talk about those shortcuts. I'm going to explain it to you. JP Morgan and Chase, as I said, reported record net income of $9.2 billion, which can be translated to $2.65 per share. And let's dig in. Let's start talking about ROTCE. Okay, so it's the return on tangible common equity. Tangible common equity, or TCE, represents the firm's common stockholders' equity. It means that it's the total stockholders' equity less preferred stock, less goodwill, and identifiable intangible assets. So let's take a look at the 10K for 2018 for JP Morgan. And with that, I'm going to give you an example how they calculated the tangible common equity, and we will understand it more. For 2018, they made an average for the common stockholders' equity, and it was around $230,000. They took out the goodwill, they took out the other intangible assets, they deducted them because they are intangible and we need tangible common equity. They added certain deferred tax liabilities and they got to a figure which was $180,000. And they divided the net income with that and they got the return on tangible common equity. So let's talk about ROE, which is return on equity. It could simply be defined as the return on net assets. Shareholders' equity is assets minus liabilities. The return on equity is simply the net income divided by the equity or net assets. The ROE is 16%. Now let's talk about Tier 1. The Tier 1 capital is the money that the bank stores in order to keep functioning while making risky transactions. So being a bank is a risky business after all, because you lend money, because you trade, you do so many things that if you screw up in one thing, you might suffer great losses. So that's why it's important for the banks that they keep money on the side, so if something happens and they suffer losses, they're not going to lose money from capital that they need. So the tier capital is the retained earnings and common stock, which also could be named as disclosed reserves. You can derive the CET1 from the Tier 1. And why it's important? So the bank's capital structure is built of 4 layers. And the higher layer is the lower Tier 2. Then you got the upper Tier 1. Then you got the AT1 and the CET1. So if a crisis happens, the losses will start going down from the bottom layer. Okay? Overall, the earnings for JP Morgan was good. There were some downfalls in the trading, for example, and other areas, but those things were expected by the analysts, and that's why the stock didn't plunge. And if we take a look at the estimates, JP Morgan beated those estimates. I'm not going to go further into that. You can really find what I'm saying to you right now in any financial website, such as CNBC or any place you search on Google. This is it for today. Thank you for watching. If you need more content and more updates, please check my Instagram account. I post there daily. Thank you very much and have a great day.